mode.
Hey everybody, Preston Brent here with our weekly roundup brought to you by our trader user group. Well, it's yes we will, no we won't, and I suspect it may be yes we will. What am I talking about? Well, I'm talking about the trade tariffs. A key date is coming up here on July the 6th. That's the date that the Trump administration said they're going to start imposing trade tariffs on an initial 38 billion of goods coming in from China, then taking it up to about 50 billion. Meanwhile, he's asked to his team to submit to him by the end of June a list of another 1,000 company trade export technology off-limit type technology things for the U.S. to China. And there's another 200 billion sitting on the table that they're trying to identify as well right now. Now, China has come back and said, well, you do it to us, we're going to do it to you. So this tit for tat kind of thing is just going to go through this machinations. But we're going to see more volatility start to creep into the markets. This past week, this week ending, the Dow was down about 2%, 2.03%. It was also down the prior week, by the way. The S&P was down about 0.89%. Nasdaq was down 0.69%. And the VIX moved up from the prior week's close, 14.9%, to close at 1377. So we're seeing a little bit more volatility come into the market, and I suspect if we do execute on those trade tariffs on July the 6th, then I think we're going to see a little bit more of a vol pop here. Keep in mind, July the 6th is a Friday. July the 4th here in the U.S., for our U.S. viewers and members and subscribers, is a holiday. So that's going to be a holiday shortened week, and I suspect a lot of traders are not want to go putting on long positions going into a holiday, probably a holiday shortened week with these trade tariffs on again, off again kind of thing, which looks like now they may be on again. The other thing that we got that happened this week, the Feds came out with the first part of their bank stress tests, and about 80% of the banks, or 35 banks, which represents, I think, about 80% of all banking assets, passed with flying colors. And then this Thursday, they got the final component of their stress test. And I suspect most banks will pass. And when they do, the Feds will probably open up and give them a green light to increase their dividends and share buybacks. And Barron's had pointed out that JP Morgan and Citi would be probably some big winners in that. So we'll see if they get a lift from the stress test. I know last time they did this stress test last year, they did the exact same thing. And both JP Morgan, excuse me, and Citi moved up. So it could be a really interesting short-term play from that perspective. Also this week, we had OPEC reaching a tentative deal on their oil production increase, but it really wasn't as much of an increase as the markets were expecting. So we saw oil just really skyrocket higher on Friday. Huge move. We haven't seen a move like that all year long. In fact, going back years for a one-day move in oil. And that puts a little bit of a wind behind the sale of oil prices here. So these are just some of the things that are on my radar screen. But the big one, obviously, is the trade tariffs. Remember, the markets are really good in pricing risk into current asset prices. They run through their risk models and they can price in risk very good. Where the markets falter and do a very poor job is pricing in uncertainty. And these trade tariffs, it's just loaded with uncertainty. And if you notice, over about 2 months ago, when Trump first started talking about these trade tariffs, the Dow one day was up 300 points, down 300 the next, up 400 one day, down 400 the next. It was insane. Finally, the markets just kind of gave in and said, we're not going to do anything right now because we believe Trump is mostly just using it as a negotiating tactic to get a better deal. And that's kind of the way the markets have treated all of this thus far. But that could all change, as I said, on July the 6th. If he does come through and he holds steadfast in his beliefs and the administration beliefs on these tariffs, then you're going to see a pretty quick reaction. Now, the Dow, I'll show you the charts here in a minute. I got the E-mini S&P 500 futures on the screen right now. But the Dow is underwater. It's red year to date. But you haven't seen anything yet. You'll see the other indexes start to move down. catching up with the Dow below water. Now that's assuming these trade tariffs come to play, or at least play out. Okay. And some analysts have estimated that if we were to do trade tariffs on everything as expected, um, that would reduce the GDP, the go forward GDP, by 1.3%. So let's see how this thing plays itself out. But right now, pricing in uncertainty, it really isn't in the asset prices. So there will be certain asset classes and sectors that will fare better if we do go into a full-blown trade war than others. And for our members this Sunday night, we'll go through some of those assets that would may be worth another look. So let's take a look at the current prices here. What I've got on the screen here is the E-mini S&P 500 futures. And as you can see, just kind of stepping it out a little bit, we've moved up, but we could not. And this was like an early warning sign for us. We could not take out that level right there. That was a key level, giving us a free shot to make new all-time highs. The markets are not ready for it. And I said, with the trade tariffs or potential of trade tariffs on the table, it's just not going to happen. So there is this huge downward pressure on the markets right now. And there is just not enough incentive to say what is going to drive the price action from this level up to this level. Now we're going into Q2 earnings in about 2 weeks, right after July the 4th. And what I think will be very interesting is if we kick off these trade tariffs and then Q2 earnings come in and they come in strong, the market's going to have a conundrum. It's going to be really interesting to see how the markets price this out. Q2 earnings are expected to come in very strong. Not quite as strong as Q1, but still very strong. 19, 20% year-over-year growth, both top and bottom line numbers. Top line probably 7% growth, bottom line numbers over 19% year-over-year growth. So, as you guys know, I say this over and over, there's only two things that drive asset prices higher or stock prices higher. That is earnings per share, and the second one is interest rates. Okay. And speaking of interest rates, right now the current yield on a 1-month T-bill, that's a 30-day interest-bearing certificate, right, on a T-bill is 1.85%. Now compare that to the trailing 12-month dividend yield of the S&P, which is at 1.89%. So big money, as it starts to reallocate, and we're talking billions and billions, but that's kind of where we go because we're like feeder fish off the big fish, right? So big money is looking at that and going, I can get interest-free rates or risk-free rather, because treasury bills are considered risk-free money. Or I can put my money in the S&P and get maybe 4 basis points more. And this is just a 1 month. So you're going to see money coming out of the equity sector, parking itself in treasury bills for a short term. I mean, remember, it's just amazing. And this has also served to flatten the yield curve, which is the 10-year, the most widely used view and measure of the yield curve is the 10-year minus the 2-year, which is, flattening right now. So this puts further pressure on asset prices, earnings per share and interest rates. Those are the two things that drive asset prices. And from a macro perspective, the higher interest rates go, the more treasury starts to compete with equity for money. And that means money will slowly peel off from equity and go into debt. Now, with some of these trade tariff issues on the table, that could move more money into debt, which would put more downward pressure on the equity market. And as money flows into debt, that'll equally put downward pressure on debt, keeping our interest rates longer term side relatively low, shorter term side relatively high, the short end of the yield curve, which is what is flattening our yield curve, which is driving banks absolutely crazy from a net interest margin perspective. That's how they make their money. So these are just some of the things I'm looking at here. When we started rolling over right here, I immediately said this is going to be our S1 level right here, right? That's our first level of support. Somewhere, from let's say 2,700 to about 2,725 area. we're at 27.56. So this to me suggests we have a little bit more downside left in the markets. And that doesn't mean we need to get there really fast. I mean, we can just go there at a leisurely pace. But that's kind of what I'm looking at right now. And the other thing is you can see the 50 EMA is sitting right here at 27.30. So this is just where the markets are lining themselves up. Now, I'm watching the 50 EMA, which is ensconced in our support, our S1 support level right here, very closely, because we're just north of the 2018 open price here, and not by much. Looking at the MACDs, we got rising crosses in the MACD, so that would suggest that any pullback is still in a mood to be bought, right? I mean, net, just to kind of give you guys my thinking right now, I think it's still a little bit too early to get full on defensive. But I think clearly it's not too early to start shifting some money out of some of the more extreme cyclicals that have just been on fire and picking up some more defensive oriented sectors in various trades, right? So this is kind of how I'm looking at the E-mini. Okay, now let me just show you where we are globally for a minute. Well, first, let me just round out our major indexes. So the S&P just above flat line here, all right, for the year. I mean, we're up, what, a little over 3%. That's about it. If we look at Nasdaq, Nasdaq is up very strong for the year. Look at Nasdaq. We made all-time highs on the Nasdaq on the 21st of this past week at 73.58.50. So making all-time highs, it just shows money has been pouring into this. And remember, when we have a hard down day, then Nasdaq is going to suffer the most. And I think Nasdaq is setting itself up for a little bit more of a pullback. If we look at the weekly chart of Nasdaq, and let's just step it out for a second, right? You can see here that it's setting up for a little bit of a divergence signal to pull back. I mean, that's the way I'm looking at Nasdaq right now. Okay, I mean, that's you can see here the 2018 high, 2018 open, 2018 open, and just some of the key pivot point levels coming down through. And that's what I'm looking at here, a little bit of a pullback in Nasdaq on a weekly chart. Now, if we come back to the S&P 500 for a second, and I'm going to put it on a weekly, and I'm going to get rid of all my indicators except for Fibonacci. Now, let me just do that for you guys. Let me just see. Whoops. Let's get it back on here for a second. Let me put it back on the SPX. I think the SPX would be better. Let's use the SPX because it's less noise and it's cash index, so it doesn't take in overnight, but it's usually a pretty good representation. So if we look at the SPX, all right, I measured the low here when Trump got elected. All right, it was down at 2083.79. So this is the movement of the SPX since Trump was elected, and you can see clearly it's had a huge move higher. And you can see in this pattern formation that it would suggest we've got a little bit more upside left, okay? And by projecting an extension off of this right there shows that we could run up just a little bit more, all right? I mean, that would be the projection is saying it can run up to 2330, 2340, all right? But I don't have enough data here to measure this projection. But the pullback here, we pull back to about the 38 fib level. And we bounced off of this. And we're kind of chopping around here. I think this move here is going to be contingent strictly on the trade tariffs. If we get through that, and let's say Trump works out a way where they're not on, and he gets a face-saving victory, and he allows the Asians and the Europeans and then the NAFTA countries face-saving ways out, then I think the markets are going to move higher. Should this tariff tiff turn into an all-out war, then I think we've seen the highs for the year back in January. So that's, it's flip a coin. I mean, how do you want to play this thing? And that is kind of the way I would be looking at this. Now, the one thing I will show, if we come back to a daily and let's look at the Russell, because I showed you Nasdaq. Russell is doing very strong right now. And the reason why is because they are small cap. They are least affected by any kind of trade tariff issue. But if we do execute on those trade tariffs, the Russell is also going to suffer, probably come back down to this upsloping trend line right here, okay, or the 50 EMA, which would represent, anywhere from about 70 to maybe 100 points to the downside on the Russell. All right. But let's look at the Dow here. You can see both the Russell and Nasdaq well off the 2018 open. But look at the Dow, folks. And this is the Dow futures. We're underwater for the year. I mean, look at the 2018 open price. We could not get escape velocity here. We're at the bottom of a channel. Essentially, if I were to draw this channel in right now, we're coming up to some key levels here, and the price action is, just kind of tracking the Dow as we've been moving higher. And every time we get down to the bottom, we go to the top, right? So we have these moves here in the channel. And we finished Friday on an up note. I mean, we were up over 100 points on Friday, but we're still below the 2018 open price. So if we take this channel out, we're going to come down and test this fib level here at 23,953. Call it 24,000. All right, folks, that's another 580 points south of where we closed on Friday. Okay, I do not see any divergences in the MACD. That suggests any downward action is going to be met by buyers taking us back up here. So we've taken out that prior pivot high, and this one here. So we're making higher highs and higher lows. If we take out this channel, we take out that prior pivot low, which is at 24,250, all bets are off. All right. So it's not going to be very long from now, about 2 weeks, when we get the go no go on these trade tariffs with China. All right, and this is going to be kind of what I'm setting up for here. In the interim, I've been having our members pick up some hedges in the portfolio on puts or calls, depending on which ETF, or whether we're trading VXX or VIX or the SPX. We got a number of different bearish strategies that we can play here. But this is something that we're watching very closely. Now, let me show you how the rest of the big planet is doing. Look at Vanguard. This is the all-world index. Look at the 2018 open. We're down 4.67% in the Vanguard all-world index. I mean, that's not good, folks. The rest of the planet is not doing good at all. The U.S. is the only pig in the pen with lipstick on. 4.67% to the downside. There's the open price. We've been slowly moving down in this channel most of the year, ever since we had that brushback, right, in February. And then we had that counter move right here. We're moving down to test that low right there. That'll be my go, no go for the rest of the global indexes. If we break that to the downside, that means the tariffs are in play, the taxes are in play, and it's going to not only damage Asian markets, emerging markets, it's going to also damage the U.S. as well. All right. And that is kind of what I'm looking at and what we've got to guard against. If we look at emerging markets, you're going to see a very similar pattern. We're down near the lows. In fact, we did make lows in emerging markets because the strong dollar is doing a double whammy. I can just draw this channel just like this, and I'll probably even make it tighter, to be honest with you, like that. And you can see we broke right down there. We took out the lows here made in February. So if I were to extend that right there, this now is panic cycle for emerging markets. Strong dollar is what's causing agita here. There is absolutely no bullish divergences here. That suggests any upward movement here is not going to be strong enough to take out prior pivot highs, which means we're going to probably come down, and this move is going to continue until something changes. All right, and I don't see anything on the horizon right now that could change that. And so the question then becomes, will the rest of the markets pull the U.S. down, or will the U.S. hold the rest of the markets up? And let's look at China. Let's not forget China. China right now is down, where it closed on Friday, 12.56% for the year. Let me just increase that a little bit. I'll increase the font size so you guys can see it a little bit better. Let's try. I guess I don't have a choice. I got to leave it. I don't want to go much bigger than that. So 12.5%. Well, you know what? Let's bold it. That way I can see it. I don't know if you guys can see it much, but let's bold the thing here. So, and this is unclosed. It closed even lower than that. It was down 13% for the year. But this is the 27 open price. So China is getting hurt more with these tariffs than the U.S. is. Remember, all indexes are in the green in the U.S. except for the Dow. Why? Because there's places for money to hide in the U.S., built out sectors and other places to go where it can't hide in China. All right. So China's really, the only advantage China has is President Xi is president for life. So he could play the long game and just play this thing out, cause a lot of pain until Trump is out of office, whether it's one term or two terms. So we'll see how this thing plays itself out. But if these trade tariffs go through, I think you're going to see a lot more pain in China, emerging markets, and then across Europe, globally, the Vanguard. And then I think you're going to see it slowly move the U.S. markets down as well. One other interesting look is this one right here. This is the Vanguard Balanced Index Fund. For those of you techno gurus out there that like to measure your performance against an index, the best one to measure it against is Vanguard. This right here, as you can see, they do a calibration at the end of every day. I should probably make this chart a line graph, but you can see at the end of each day, they take a net asset valuation of the portfolio. And you can see where we're sitting right now. We're above the 2018 open price. Now, why is this so interesting? Well, this is not equities. This is an index from Vanguard. And remember, Vanguard's got trillions, so it's one of the biggest out there. It represents a mix of 60% equity, 40% debt. So if you're running, let's say you're a trader out there and you're trading equity only, you're a retail trader and you're up 5% for the year, or you're down 10 or 20 or 40% for the year, you can say, where is the Vanguard index compared to where I am? And you can see where we're sitting right now. So you can say just a typical mutual fund a balanced portfolio of 60% equity, 40% debt. This is kind of where we're sitting right now. Okay. Now, let's go take a look at volatility. Volatility basically came in on Friday, but it finished the week at 13.77. We're at the upper band of the green zone right here, right? We're still relatively low. I believe over the next 6 months, we're going to have one, possibly two events. They're going to cause the VIX to move back up into this almost red zone up here to challenge these highs here around 20 to 25. So just be prepared for it, folks. It's going to be an event that I think is going to happen. I think the markets can still grind higher, but we're subject to these vol spikes, which I think we're going to get one this summer. The other thing that I'm looking at is if we look at treasuries, look at the bond market. I believe bond interest rates are still going to stay steady to go lower. Remember, when I say the bond market, I'm looking at the 30-year bonds, right? And you can see here on the further end of the yield curve, interest rates want to stay lower. Why? Because money is coming into the U.S. from Europe and Japan investing in our bonds because they can get better interest rates to the tune of about 250 basis points more. It's really amazing. 220 to 230 basis points more. So big money is coming into our markets and buying our bonds. Okay. So interest rates are a lot better and they're considered risk-free. So that in essence keeps bond prices moving higher and our interest rates staying steady to moving lower. So that's kind of where we are on interest rates right now. And then if we look at currencies, you can see, that with our interest rate policy, the dollar this past Thursday made 2018 highs of 95.2, the dollar index. This is another thing that's killing emerging markets. But you can see we're setting ourselves up for a divergence here, which suggests the dollar is probably going to pull back just a little bit. Okay, I know the Trump administration doesn't want a strong dollar, but I think the dollar, just looking at the chart patterns here, suggests it's going to pull back a little bit. And then by that means the euro is going to move up just a little bit. But my near-term forecast for the euro over the next 90 days is to move lower. All right. I just don't think Europe is as strong of an economy as they think. And I'm calling for a little bit lower price in the euro of about 1.144 in the euro. Okay. Meanwhile, the British pound, poor Theresa May is just having a hell of a time. It broke our upsloping channel. So you can see here we do have some divergences here suggesting that the price can move up a little bit, but I think the pound right now is just getting pounded. And it's subject to headline risk with the Brexit, as there every single week it seems like there's some other issue coming in with the pound. And they've just, the pound, remember, back only in April was up at 144 to the dollar. And now it's down 133 to the dollar. That is a huge, huge move to the downside. Okay. And if we look at our channel here, you can see here, since the Brexit vote, we were playing the pound to the long side. And you can see every time we were at the bottom of the channel, it would suggest buying when you got a buy trigger, and at the top of the channel, selling when you got a sell trigger, and it kept you out of trouble. And then we just moved all the way up. And then up here, these were definite sells because we were having the divergences here. And this final one was the final capitulation, and we broke the channel, and we even took out a prior pivot low. So we're now sitting right on that prior pivot low. If it can hold and get a little bit of elevation, and let's say over time this prior pivot low at 13281 holds, then I would suggest maybe a little bit of a grind higher. But right now, I'm not in that mood, all right, with the currency market. And meanwhile, the Japanese yen, which is kind of a global barometer of risk on, risk off, you can see has really moved down hard since the end of March, right? And we're just in this choppy downward move right here where it's just kind of chopping up and down, up and down. There is no trade in the yen right now that I see, all right? I think the odds favor the yen to stay in this choppy range. I don't see a trend developing just yet, so there's nothing there, okay? And then, of course, if we look at metals and gold, gold is playing out kind of the way I said. I just said that if we can't get above the 2018 open price and we chop around here, we're coming down. If you guys remember, I put that on the screen and I said that is a near-term forecast of 1283. And then gold closed the week at 1271. All right. It came down and shot through as commodities typically do. They always overshoot both up and to the downside. You can see that we hit the 2018 lows. I suspect gold still has a little bit more downside left in it before it starts a longer trek to the upside. Okay. Remember, I said right here there was no divergences, so that suggests any up move should be sold rather than bought, and that's what happened. So that kind of played into our sweet little hands there. Meanwhile, silver is in this very elongated pattern here of these symmetrical triangle, and every time it tries to break out, it doesn't break out, and it hits this other. You'll see I've got two triangles in here on this thing, right? And we're sitting in both of them right now. When we break out of this bigger one right here, we're still in this other one. I do believe over the next year and a half, silver is going to be back up over 20. Meanwhile, in this area right here, it's very choppy. All right, but there is a lot of firm support underneath silver. So that would suggest silver could outperform gold over the next 12 to 24 months. And I think both of them will be higher. Just near term, it's more a day trade. The macro view in my mind is longer term. And speaking of metals, let's look at copper. Copper is off its 2018 highs. Remember, copper is called Dr. Copper because it's more about industrial. It's got a heavy industrial use for the metal rather than the precious metals like gold and silver. You can see the high price for 2018 was it was only about 3 weeks ago. And then look at this price. This is a result of all the trade talk and tariff issues in the month of June. And you can see China's the biggest buyer of copper. China's having some issues with their economy right now. So the trade tariff battle couldn't come at a worse time for China. And look at this. I mean, for copper to give it up like this, and we're sitting on this key support level. It's a psychological barrier too, right around the 3 level. I mean, you can just see how we've held up all the way going back to April. I mean, it's just been a pretty kind of firm support area. And then we just busted through it and took out our 2018 low. I suspect the near term for copper is down. That would suggest the global economy still is not looking that good, guys, regardless of what Nasdaq and the Russell is doing right now. And then, of course, if we look at energy, I mean, look at oil. This guy just exploded higher. Look at that. Bam, all the way up here like this. 3.74, moved 5.71% in one day. Biggest move we've had in oil in a long time. And we're off these lows down here just on the 18th around 63.57. That was a result of OPEC. And based on the way they calculated, they said it works out to $1 million barrel increase per day, but the true net calculation is about 600,000. The market had priced in anywhere from 1 million to 1.5 million barrel a day increase, which is why oil was down in the low to mid 60s. But now that they came out with what they came out with, I suspect we'll have some chop here this week. But the natural inclination of oil is to basically move higher, probably into the high 60s, low 70s as we go through the summer months. That's kind of how I would see oil near term. And if we look at Brent, because Brent also moved, but nowhere near as much as WTI. Brent moved up on the day 3.64%, right? So we've still got a little bit of this downward trek in Brent oil here, right? I mean, if you look at the channel, we're right at the top of this channel with Brent right here. So it's going to be really interesting to see what happens with oil after this big Friday move. Now, if we look at the spread between Brent and WTI, here's the spread. Look at the spread. We were 11.43. Brent was 11.43 dollars higher than WTI. And then leading up to this OPEC meeting and then after the OPEC meeting, it just gave it all up, and we're near the 5-year averages right now. Here's the 200 EMA and here's the 50 EMA. So the 200 EMA, which is the 200-year or 200-day average, not 5-year, but 200 days, it's around 562. But the 5-year average is around 5. So that does suggest that we could see a little bit more downside action here and a little bit more strength in WTI versus Brent. Now, for our members, we traded this spread. We traded some downside move in the spread when it was back up in this area a couple of weeks ago. We made some money on it. It was a really interesting play for us. But that was a good play nonetheless. All right, everybody, that's kind of just my weekly update for our members. I'll see you Sunday night. We got a lot of things we got to go through. We got to look at some of the defensive side. If you're not a member of our group, we're getting a lot of international folks as well as folks that like the commodity side to maybe do a little bit better allocation instead of just all equities. Come on in and check us out. Just check out our specials. We've got a number of things going in our group. We're growing it nicely. So come on in. Otherwise, members, I'll see you this Sunday evening for our upcoming weekly market watch. Take care, everybody. Have a great weekend. Ciao, folks.